Hi, and welcome to Shared Lunch. Today, I'm at the William Sanders Village here in Devonport, Auckland, with Ryman Healthcare. Ryman is one of New Zealand's most well-known retirement and aged care providers, and shortly I'll be joined by its CEO, Naomi James. In this episode, we'll be talking through the Ryman business model and what's unique about it, what's been most challenging about the last few years and the significant reset that the company's undertaking, and what this next chapter means for Ryman's staff, its residents, and its shareholders.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Hi Susanna, welcome to William Sanders Village. It is great to have you here today. Let's go have a look. We're in the heart of the village. This is where all of our residents can come to socialise, to do activities, from our happy hour to our bowling green.
Not to mention the piano that I noticed there too.
So we're right in the centre of the village now, Susanna, and you get a sense of the scale. This village has been open for 7 years. The gardens are really established. They're a key part of what our residents just love. And all these places to go and sit, enjoy the surroundings, meet with friends from the village or from the community, they make for a really special place to live.
Oh wow, what a view.
It really shows you the premium locations that some of our villages are in. We build these really high quality assets. We build to own, and so we want this to be a great home for 50 plus years for the people who will live here.
Thanks Naomi so much for having us and hosting us in such a beautiful library here at the village.
Great to have you here today, Susanna.
So it's been a challenging few years for Ryman and for Ryman shareholders. And this is such an interesting and frankly pivotal time for the business as you've been tasked with leading this reset and changing the trajectory for the company. I'd love to talk a bit more about that in this episode. Before we do so though, I'd love to zoom out a bit for our listeners and for our viewers. How would you describe what exactly Ryman does?
I think one of the biggest misconceptions in this industry is that it's just a property business. It is so much more than that. Yes, we have a really significant property portfolio, over $12 billion of property assets in our portfolio, but we're also a very large healthcare business, and we have relationships with our customers that last a lifetime. And so it's that combination of that really brings this unique value proposition for our customers, our residents, as well as we think for shareholders, especially with how the growth and outlook is going to come in terms of the ageing population.
Both Australia and New Zealand are ageing populations and ageing quickly. What are some of the structural components over, say, the next decade that need to take place in order to translate to a healthy sector and a great business?
One of the things that is less talked about is how we need to change how we are delivering to a much larger population. We need to evolve our business and evolve our sector, and do that in a way that is going to align with the government funding settings and policy settings. We need to have more care in the home. We need to have higher acuity care in residential care settings. The baby boomers are more and more going to become an increasing part of our customer base, but they're very different consumers. They want a lot more choice. They're not old. And so they're looking for different things. And so all of that means we need to think about how we evolve and continue to serve both our residents and form part of a really healthy system that is able to meet the needs of this much bigger population that's going to be coming through.
And you talk about, Ryman, it's much more than just a property business, albeit that property portfolio is large and property prices and interest rates that are clearly a key dependency are a big part of that. How do you manage those risks that really are outside of your control and ensure that you've got still a really strong underlying operating business?
What we've done with our strategy refresh we've just announced is really looked at those things that have been key to our success in the past. We are renowned for the quality of care that we provide to our residents, and that drives a huge degree of community trust. We've got a brand that is a household name in New Zealand, and we've built that recognition in Victoria now with the investments that we've made. At the same time, all of those things haven't translated into financial success, and they've been the things we've got to address. Part of the problem of the past was that performance was not transparent. You couldn't necessarily see financially how the business was performing. We then need to go and improve it. And so having stabilised the business over the last year with a reset balance sheet and a reset in a lot of our pricing and terms and our cost base, we now are able to really make a shift on improving performance and looking at how we grow these recurring earnings out of this business that should be fairly consistent and growing over time, and manage the more cyclical side of the business, which can be the property housing market. And a big part of that was a changed approach to development, to say we want to grow, but we want to grow in the right way and be really clear when we're deploying shareholder capital in the future, we can give confidence to shareholders on the return they'll get on that capital.
We have been in a bit of a period sort of further back than the last few years where we had declining interest rates for a long period of time and then ultra low interest rates. And clearly that's a massive tailwind for property prices and then indeed for a company like Ryman with a large property book. So in your view, did that actually perhaps mask some of the deteriorating operating parts of the business, hence why your real focus on that transparency, so that it's really easy to understand what are those underlying dynamics and being able to diagnose those much earlier on?
If you think about what happened in New Zealand post GFC, we've had very much above average trend growth in property prices driven by the population growth that occurred. We've then had COVID, we've had a bit of a reset in the property market, starting to recover, but still, quite a recovery to come, particularly here in Auckland where we are today. And so we've got to have a business that isn't just works in strong property strong cycles. It's got to work through the cycle, and that's really the shift that we're making. We don't want to rely on just big capital gains in the way that occurred in the past, because we're not in control of that.
With those interest rate cycles and with different property cycles that you might be going through, I'm just curious to know, how quickly do you see those show up in your numbers? That sluggish property market, when you're seeing those green shoots, how do those sort of reveal themselves in the numbers as well?
Yeah, so most of our residents will need to sell their family home to move into the village. People want to sell in the right property market. So we definitely see the impact when we're in those down cycles in terms of turnover rate of at which people can sell. And when the market comes back, it goes the other way.
Yeah.
So we have higher levels of stock today than we'd like to have. There's no doubt that it's easier to sell down stock in a stronger property market. But the business model can't be dependent on that. And if you think about the scale we have and the unique offering we have, you do want a bit of scarcity. There's something special about coming into a Ryman village, and we also make it really seamless for people in moving in. And there's a lot of things we're working on to make that experience even better. And our offering is uniquely suited to where we see the strongest demand coming through in the future, which is in assisted living as well as through to care. And so as people start to think about potentially needing a bit more support or help in the home, or just wanting the security of knowing, when I need care or when I need more help and support, it's going to be there for me. that's often what drives decision making, and our job is just to make it really attractive and a good value proposition. No doubt, when the property market tailwinds come back, it makes our job a lot easier. But we're not waiting for that. We focus on the things that are in our control, and really driving performance throughout the cycle.
I'm also thinking about these residents and the retirement sector, and it is such a important part of the social fabric, for New Zealand and for Australia. We all have loved ones, we all have elderly relatives who we really want to see looked after, and it's clearly such an important part of living with dignity in their latter years. There's so many trade-offs that you must have to balance around resident outcomes, around staff workloads, around affordability, shareholder returns. How on earth do you think about balancing all of those outcomes?
We always start with our resident in mind first. People choose to work for Ryman because of all those reasons that you talk about. We employ staff who love older people, who want to serve and support and care for older people, who want to provide them with that choice and experience, so that your latter days, they can kind of be these full days where you experience more connection and joy often than when you're living in the community where it's a bit more isolated. So we don't compromise on the quality of the care. At the same time, we have had to do some resets in the business. We've needed to bring a lot more just discipline through the business in terms of how we manage our costs, our non-village costs. We've taken a different approach to our development, not having a big development team where we have to keep building to keep those people employed to cover those costs. We've also needed to review our care capacity here in New Zealand, where the funding settings aren't right at the moment. And that's seen us close 2 of our care centres as a result. But again, when we make those decisions, when we do that, we are constantly thinking about what's the impact for our residents, how do we keep them at the centre of what we're doing, because that's key to our success long term.
Ryman is often described as having a very distinct model around that full continuum of care. Could you talk us through, the resident journey from start to finish, and then how value gets created? So someone that might be looking to buy a unit, they move in, maybe when they go into sort of greater care after a decade or a decade and a half. Can you talk us through that journey?
If I summarise it in one word, it's one move. This is often the biggest move people will make in their life, to leave their family home, and you're moving once. So when you come into a Ryman village, whether you're coming in to independent living, or you're coming into a serviced apartment with assisted living, or you're coming into residential care, what you can have is the confidence that there is the capacity and the offering at the village to meet your care needs and your support needs as they change over your lifetime. We don't just have the flexibility in our model to provide care across the village. We've got it to provide it at a resident level based on what you individually need. And the portfolio's got that. And this is unique about Ryman. 50% independent living capacity, 20% assisted living, serviced apartment capacity, which you can provide residential care into, or you can live more independently in, and then 30% aged care capacity. So a really sizable, flexible offering in premium locations. That's unique and almost irreplaceable in terms of being able to be copied in the market. How does that work financially? In simple terms, at the independent living, if you think about what we're providing, it's a home, We're looking after the gardens for you.
Yeah.
We're looking after the building maintenance.
It's peace of mind,
It's
isn't
peace
it?
of mind. You don't need to worry. You just enjoy living your life with the activities available on site, but also to free to lock up and go and do whatever you're wanting to do and know your home is secure. And the financial returns in that side of the business are more in the growth with the capital gain on property over time falling through to the shareholder. So our job is to manage the costs of the business, to recover those through the weekly charges and that, and we've had to do some resetting to make sure we can do that, and then manage the portfolio really well so that we're investing to grow that capital gain, to realise that capital gain for our shareholders over time. And the resident funds, the funding from our residents putting capital in, helps us provide that low cost of capital that enables that model to work. If you go to the other end, the care end, this is a services business. So this is a margin business. It's fairly high cost to provide care. Occupancy is really important. Utilisation is really important. Understanding where and how you make money and where you might not make money. And so at that end of the business, it's about managing well for margin with high occupancy. We're the largest aged care provider in New Zealand. That gives us the scale to do those things really well and to offer a unique proposition that if you're a smaller operator, can be quite hard to do. But scale, truly integrated living in an irreplaceable property portfolio, unique locations like the one in Devonport where we are today, that's a pretty unique asset base.
Well, let's talk a bit more about care. You've mentioned that it is really a service business. It is really about being laser focused on the margins. You also mentioned that you've closed 2 facilities recently, and that model is clearly quite challenged at the moment. And I know there's been a lot of dialogue between industry and the government in New Zealand around what needs to change and some of the settings that are just not working. Can you talk us through some of those settings now? What is broken about the model? What does need to change? And any other thoughts that you've got around that?
Australia's a little bit ahead of New Zealand, having already worked through its funding reforms. But New Zealand right now is right on the threshold of that. In simple terms, we need to make sure that care is properly funded. We need to provide more care in the home, and we need to provide higher acuity care in residential care settings. That's reflected in the government's policy on both sides of the Tasman. How does that translate back into our business and those reforms? The aged care funding has lagged growth in costs. It's very well understood and documented in multiple government reports. What we need to work through is the new funding regime that's going to set us up for the future. So clinical care, which is the entitlement of everyone, being funded by government and being funded properly. And then accommodation and living costs in the same way as when you live in your own home, you pay for those things. Yeah. And so a shift to, if you can afford to pay, you pay. And where people do need support from the government, that's available too. Yeah. They're the big shifts that are coming. We're on to this exciting phase with the Ministerial Advisory Group that's been set up to work through what's the how. How do we actually make that happen? And how do we make that happen not in 5 years' time? How do we make this happen next year? Because if we don't address this, the risk for all Kiwis is that it impacts our public hospital system. Yeah. Good care for our older citizens is an everyone issue. Yeah. And a well-functioning public health system, actually it's foundational to that.
In the latest results, the interim results at the end of last year, you did record a positive free cash flow, which I think was the first in over a decade. Can you talk us through A, what is free cash flow, and then B, how did you achieve it? How did you turn that around, and what were some of the levers that you needed to pull to do that?
Yes, in really simple terms, free cash flow is you look in the bank account and there is more money in it or less debt.
Yeah.
So the great thing about cash never lies.
Yeah.
And so one of the shifts that our board made before I joined was a shift in our reporting to put much more emphasis on cash-based metrics, which is really where we've already built our villages. What's the cash they're generating?
Yeah.
Cash flow from development activities. How much are we spending in investing in new facilities? And how is that recycling capital to invest in the next one? But having really clear line of sight to both, the asset base is still well under earning what it should be. But that's about resetting our cost base. That's about resetting our some of our pricing to market.
Yep.
It's about adjusting our approach to development to build in line with demand. So we've made early progress and a really great start to that, but we've still got a good amount to go, and we've been really clear what we're targeting. So $150 million improvement in sustainable cash and performance, and a $500 million release in cash release from the business by FY29, so in the next 3 years. Yeah. We'll keep reporting against that. We'll keep telling people how we're going.
Yeah.
But we want to be really clear and transparent with the market about how we are properly managing what is significant shareholder capital.
I'm curious to know what have been the hardest couple of calls you've had to make since joining Ryman, and if you talk through maybe some of the trade-offs that you had to think about through those calls.
There are some big decisions that are much bigger than others, but ultimately I know my legacy as a CEO you will only see when I'm no longer in the chair. It's in the long-term capability and capacity. Each time we're approaching a big decision, an important decision, how are we building the capacity within the organisation to make good decisions? Not just this one, but the 10 that are going to come after it, because that's what's critical to long-term value. Yeah. What's been hard, we obviously had to make early on in my time a decision to come back to shareholders, and I should acknowledge and thank our many Sharesies shareholders who supported us through that. That's not easy, but having done that, we are so well set up. Yeah. The balance sheet side is done. It's reset. We can now fully focus on getting this business performing. Similarly, when we took the decision with a couple of our care centres, they're hard decisions to make because we know they are people's homes. But what we did with our teams and what we did with every single one of our residents at those sites was worked with them one-on-one. It was so wonderful to get the feedback from many of our residents who moved to other villages to not just have managed that change, which can be, quite difficult, but they were so excited to be moving to a newer village, a new home. So we're making good decisions for shareholders, but we're also making good decisions for residents. So I think, yes, there's been some hard decisions, but actually the organisation is leaning into the change and, as importantly, the opportunity that it presents for us to not just get through this bit, but lead the industry for the next 40 years. Because that's what Ryman did. 40 years ago, it invented the continuum of care model and it led the industry. And that's what I'd love to be the legacy.
Well, speaking of opportunity and about growth and the next 40 years, I'd love to turn to Australia. You recently dual listed on the ASX. So tell me about, how do you think about Australia and what does success look like there?
So Australia's got lots of the similar market opportunities, the ageing population, the housing shortage, and the housing cycle, the rebound in the housing cycle that's coming. Where it's different, it's at a different point in funding reform, as we've touched on. And also, Ryman today is only in Victoria. It's a much bigger market than New Zealand. We are large in New Zealand. We are the largest by a good amount. We have established scale and platform now in Victoria, and we want to build on that. So part of the ASX listing was really a foundation to go and say we see future growth and opportunity to be a bigger player in Australia.
Yeah.
We're open-minded about how we do that. We're also very disciplined in how we think about growth, and that was part of what we've set out in our capital management framework. So whether it's more greenfield growth, new sites, we've already got a good quality land bank over there, or M&A or other ways to grow, we definitely see that as a key part of our future.
You mentioned M&A and that being a possibility. There has been quite a lot of consolidation in the Australian market. So how likely do you think that is? Could we assume that there are sort of no plans to raise additional capital in the future or need additional capital in the future outside of something like a big M&A opportunity?
M&A is not our focus at present. We are focused on getting the operating performance in the assets we have today to get that return for shareholders from what is already been invested. And clearly, when we're trading at a little under 0.7 times NTA, we wouldn't want to go and pay 1 times NTA dilute our shareholders. That would be nonsensical. But we do see M&A potentially in the future as the business performs better, and we are watching the consolidation that is playing out in Australia. Scale matters in this industry, and it's going to matter even more in the future. And so I'd say we're going to monitor, we're going to focus on getting our existing business performing first.
Great. And finally, I'd like to finish with a bit more about you at the helm of Ryman. And speaking of capital intensity, you came into the retirement sector from a background in heavy asset, regulated infrastructure, big operational environments. So, while a different sector, definitely parallels. What leadership instincts from your previous roles have you been able to apply here or been most useful? And are there any that you've had to maybe tweak or unlearn, because retirement is a different ballgame?
Yeah, so in terms of the similarities, these are big capital intensive businesses. That means getting capital decision making, capital allocation right is critically important. They're big cost businesses. That means disciplined operations and operational excellence is important. And they're big, quality and safety. We provide essential services in the same way as we did in my last job. And so being really clear on not just the financial performance, but the non-financial, those quality, safety, clinical indicators. So while we're measuring different things, it's actually the same ingredients. From a leadership perspective, we've touched on the creating clarity and setting standards in organisations like this is critically important, particularly through change. And helping people know what is expected, know what good looks like, and thinking about how they're going to continue to improve and contribute to that. I see a key part of change. When you get organisations leaning into change, it's an opportunity not just for organisational growth, but for personal growth. And organisations don't just survive change. People don't just survive change, they get stronger because they lift to respond to the challenge.
Rise to that challenge.
And they come out better versions of themselves. And I have no doubt that's what Ryman will be. And so that's the opportunity.
Well, Naomi, thanks so much for your time and insights. We've covered a lot. And thanks to listeners and viewers for tuning in. You can catch this episode on YouTube,